Yeah, I think it's amazing actually, just looking through it, 25 funds, 25 funds now on the list, and a very high quality range of funds run by very strong teams, and I think it's come a very long way since I started, which was 2001, when there were just a couple of teams out there doing SRI. There wasn't that much choice. And I think the other really interesting thing is that it's spread across asset classes. So it used to be that ethical funds were mostly focused on UK growth, your UK ethical fund, but now we've got global corporate bonds, so it's moved a long way. I am Peter Michaelis. I head up the Sustainable and Responsible Investment team at Alliance Trust. We have been there almost 2 years, but we've got a much longer pedigree. We started at IFA Investors, where we launched the Sustainable Future Fund range, which feature in the list of rated funds. We moved across with the funds lock, stock and barrel, so the funds have carried on their track record since 2001, and the team largely has moved across as well. And I wanted to talk just in the 10 minutes. We've got a little bit about what we do, how we go about what we do, and what we see as the prospects for SRI in the future, which we think are very strong, and this is one of the pieces in the puzzle that needs to be there for the growth in SRI to actually meet the apparent demand that you get from all the surveys, such as the ones from UXIF. Just start with the team, because I think this is an important thing, and a feature of a lot of the funds featured on the list is that they're strongly resourced. This isn't just giving a fund to a successful UK fund manager who's got a big mainstream fund of $1 billion and saying, you can run this little ethical fund on the side. These are teams, it's certainly the case with our team, this is all we do. We believe that the sustainable future approach is one which will deliver obviously asset growth, strong returns, and become a successful business in its own right. Very experienced, most of us have been doing this for over a decade, and the important thing as well, another feature of the change, is that having a separate team that does the ethics bit, and then you have the fund managers who just get given a list of things that they can invest in. That's become very outdated. So the way our team works, and the way a lot of other teams on this list work, is to actually, everyone does the integration. If you're covering industrial companies, you will look at environmental pollution incidents or at environmental management, because it's important to the understanding of whether that company is a good investment or not. Being much more focused, being well-resourced, and integrating the issues is a feature of these funds. So what are we actually trying to achieve for our clients? So if you invest in the Sustainable Future Funds, what is it we're going to do for the fee that we take? And twofold. The first is to deliver strong investment returns by investing in more sustainable companies. So these are companies which are helping to improve quality of life or to reduce environmental impacts. So they're doing something good for society more broadly. And we benchmark ourselves against mainstream benchmarks. So we're not saying this is, you have to sacrifice returns, and that's key to what we're aiming to do. And I'll talk more about the sort of companies we invest in. But there's an important second element as well, which is that we believe that as shareholders, we have an influence, and it's an influence we should exercise to improve the way that companies are run more broadly. And there's a voice that shareholders have, which no one else has, because we're the long-term owners. The clients of your clients are going to be invested in these companies for decades. They're the long-term owners. They're there longer than management. They're there longer than most fund managers, and they have an influence. And this can be incredibly powerful. And one of the best recent examples of this has been how the fund management industry, or those that are interested in this area, have engaged with clothing companies following the collapse of the Rana Plaza factory in Bangladesh. It was a real live issue. 1,000 people were killed about a year in April 2013 in a building that was unfit for purpose, and they were supplying all our main high street stores. The fund management, or about $1 trillion worth of the fund management industry, engaged with the management of a lot of our clothing companies to say this isn't good enough. You know, we, as long-term owners of these businesses, cannot tolerate this as a business practice. And the idea of the whole race to the bottom, find the cheapest suppliers out there, and you know, if it's not China, then go to Vietnam, then Bangladesh, and then Burma. And I'm pleased to say, after a year of very hard work, over 150 companies have signed up to new standards of operation in Bangladesh, which we feel go a long way to making sure that this sort of disaster doesn't happen again. So it's just a small example of the power that shareholders have to change the way that companies operate. And so we report back to our clients on the activity we do on their behalf in terms of engagement, but also on the investment returns we've been making and the types of company we invest in. And that's what we believe our clients are interested in. So, turning to the investment side, and this is where I think there's a real divide between the perception of most investors, most sort of the 55 to 65-year-old IFAs out there that say, if you're taking ethics or sustainability into account, you're making an arbitrary decision to limit your investment universe. Therefore, you've got fewer investment opportunities. Therefore, you're either going to underperform or you're going to take on more risk. So that is a deeply held view out there. And you know, throughout my 10 years, it's been so hard to change that view to our view, which is that actually companies which have strong sustainability characteristics have an edge. They have an advantage. And this is backed up by, there was a survey that Accenture did last year of 3,000 global chief executives and said, you know, one of the questions was, is sustainability important? 90% said sustainability is important for future success of our companies. So chief executives think it's true, or at least they think they have to say that it's true. But they recognize it's important. And increasingly there's more academic evidence as well. So a lot is coming out of Harvard Business School, where you know, the likes of Michael Porter and there's a guy called Robert Eccles who's doing a lot of work on this, analyze companies, and they see that companies which are operating in society's interests for the good of society tend to generate better financial returns and better stock market returns. So, you know, to our mind, if chief executives think it's important, academics think it's important, investors should too. Now, we believe it's still very overlooked by mainstream investors, and so it can give us an advantage if we incorporate into the way we invest, and we firmly believe that's true. So we, you know, have the little pink fuchsia bubble on there as well, which gives us that extra advantage, but it has to be married to analysis of the business fundamentals. It can't just be a company which is run by a person who's got kind of great ideas about turning sewage into gold or something. If it's not a strong business, it's not going to work, and it has to be on attractive valuations. You have to have a very robust and disciplined approach to that as well. So we use 4 themes. It's a sustainability theme, and I won't spend too long on them, but these are themes which we think are going to carry on regardless really of where we are in the economic cycle. Every economy is decarbonising. You know, we saw from the US last week a huge step taken by the US to decarbonise their electricity supply, reducing it by 30% by 2030. So that's incredibly important. It's going to persist. Quality of life. Our economies exist to improve our quality of life. That's why we could all cooperate together. So this delivers to sectors in healthcare, food producing, education. Again, these areas will grow faster than the rest of the market. Consuming sustainably is, I think it's best typified by Ellen MacArthur, who has set up the Circular Economy Task Force, because as she was, had her time to ponder things as she was sailing across the Pacific Ocean, she was noticing all this, plastic bags and rubbish floating around her. She's like, what is all this? And it comes with the fact that most of our economies are linear. We'd spend all this effort making this stuff, making these iPhones, designing them, so cool, then we own them for a short period and then into a hole in the ground. I mean, it's absolute lunacy the way our economies are operating. But regulation is driving these economies to become more circular in the way we use resources and materials. And so that is our third theme. And then the final one is you can't just have an environmentally efficient economy, it has to be robust. So you need companies involved in supply chain auditing, in putting health and safety systems on cars, and doing internet security as well. So these four themes are where we focus our analytical resources to identify companies which are going to grow more, and because of their approach to sustainability, they're going to have higher quality management. And that's really our investment approach. I'll just do one example of the three that I've got here. I can talk you through the others at any point. But in the climate change sector, the best way to reduce our use of fossil fuels is to use less energy. Now, 40% of energy gets used in buildings through heating and lighting and all the services that we use in them. So the best approach, and the one with the quickest payback period, is to insulate buildings more. One of the best providers of insulation is Kingspan, who do these products over here, which are, over here it's a 65% less heat loss than your typical mineral wool. They have a product which is fantastic in the building supply sector, building products sector. They are unashamedly out to make money and make profits. They've seen fantastic sales growth. So since 2009, the sales have increased by about 50%. Because every time a new building is built, it has more product in it. And they've managed in a very, very commoditized sector to maintain high margins. So we think this is an example of a company that is growing precisely because of its approach to sustainability. So it's not a hindrance. This is what is making this company successful. And that's what we aim to build our portfolio from. This is an example of healthy eating, helping us to eat a bit less of the bad stuff and a bit more of the good stuff. And Johnson Matthey, who is a fantastic company making catalytic converters, as China cleans up its act in terms of its air, it's going to demand many, many more catalytic converters. This isn't China, this is London on the Atlantic Bay. This is where, this is where George and I cycle around town, puffing around. This still causes 40,000 people die in the UK a year from outdoor air pollution, so it's still a major issue. How am I doing time-wise?
Carry on.
Carry on, okay. So we take all those stocks that we come up with from these ideas, which we think are very strong investment stories because of their approach to sustainability, build them into robust portfolios using all the standard risk techniques, in terms of the sizing of the stocks that we hold and the sectoral diversification, to build robust portfolios of around 40 to 60 stocks. This is our global fund. Just a few characteristics: 49 stocks, a beta for the market of about 1, just over 1.05, active weight 9.94, so almost 100% is when you totally deviate from the benchmark. It's a very active stock. It's certainly not a benchmark-hugging portfolio. The tracking error is, we'd like to keep it between 3 and 7, so it's not a hugely risky fund relative to the portfolio. A broad spread across the themes, so because there's not so much correlation between the themes, it's actually a good thing. And these are the top 10, which make up about 30% of the fund. This is MSCI World, so standard benchmark. So the portfolios that we build are structured in a very similar way to classically actively managed portfolios. What's different is that integration of sustainability into the way we actually select companies. So to the question of performance, do sustainable, ethical funds underperform? And we think, from our perspective, the answer is no. There's absolutely no evidence of a clear underperformance. And our fund, so this is over, if you look over 5 years, 5 out of 6 of the funds are outperforming their benchmarks. Over 3 years, 6 out of 6. We've got another 2 funds which are peer group ranked, which are managed fund and absolute growth fund in there too. And they're both first or second quartile over 3 years as well. So to have that performance across a range is, I think, quite rare. And to me, it signifies that we're onto something, that there is a driver in there from sustainability which helps us to deliver steady outperformance. So, additionally, we looked at the volatility side of it to sort of see, do we take unexpected levels of volatility for a particular asset class? And again, we seem to be looking back either in line with the benchmark or under in terms of volatility over 3 years. So it's quite a compelling proposition, I believe. So how's it gone so far? Since we launched the funds back in 2001, back in with 0, there's kind of been steady growth. And we run about 1.6 billion assets under management to date, across the range of asset classes here, and each asset class is, of a size that is self-sustaining. Now, we went on a roadshow around the UK last autumn, and Ollie escorted me around some of the gritty areas of the UK. Sometimes we'd only have 1 or 2 IFAs there. But the feedback we got, and it wasn't all green IFAs who came to this roadshow. Some of you did, so thank you. And when we asked them, we said, okay, so you've never recommended an SRI fund in your professional career, why are you here now? They would say, either it's a new generation who are taking on the money, who are now really interested in it, and I've got to bone up on it because I don't want to appear ignorant. Or they're just seeing increased demand coming through. And so they wanted to understand a little bit more about SRI. And then we'd ask, okay, so what have you done when people have come to you with ethical concerns in the past? And they would say, when we got to that bit in the fact find for our ISO 22222, we would say, you're not interested in any of this ethical rubbish, are you? Definitely going to lose money. Definitely going to lose money. So, but I think that I get a real sense that's changing. And the launch of this risk rating is one of those elements which says that SRI is a part of the investment landscape, and it's something where people should consider putting a part of their assets in, or all of their assets in, and they can do it in much the same way as choosing any other investment strategy. Or if they have very strong ethics or values, it's appropriate for them as well. And so that's why we feel that there are really strong prospects for growth from SRI and from initiatives like this. Just a final plug, since we're sponsored, we're about to do a bit of plugging, but if you want any more information on our funds, or to look at the sort of issues we talk about, there's a hub, an SRI hub, which we've set up on our website, and any of the issues like fracking, or competing investments, and we'll probably stick this up as well, I think. Anyway, with that, I will stop. Thank you, Julie. Thanks.
Thank you.